Hey everyone, this is John Boyd, host of the Emerging Wealth Podcast. Thanks for joining us and making us a part of your week. Before we dive in, if you're finding value in our content, please give us a like. This helps us reach more listeners and share quality financial education. Next, I'd recommend visiting our website at www.modernwealth.com. Head on over to our Learning Center. It's packed with videos and articles designed to help you optimize your wealth. While you're there, consider subscribing to our newsletter. Thanks again for being with us. Now let's dive into this week's episode. We're talking all about 3 tax-savvy ways that you can access your retirement accounts and retire early. You don't want to miss today's episode. Welcome back to the Emerging Wealth Podcast. I'm your host, John Boyd, certified financial planner and founder and lead wealth advisor at Modern Wealth. And I'm so glad you're here today because we have a good one for you. So you may or may not already know, but most retirement accounts, generally speaking, like an IRA or a 401k, if you were to try to take money out of them prior to 59 and a half, you would have to pay ordinary income tax. And on top of that, you would have to pay a 10% early withdrawal penalty. How the tax code is set up is that it incentivizes you to work until you are at least roughly 60 years old. And then at that point, you can go ahead and access your retirement accounts without penalty. Now, again, whether or not you think that is BS or baloney, I don't make the rules here. That's what the IRS wants you to adhere to. But because you listen to this podcast, you're going to find some pretty tax savvy ways that we can work around this. So, again, should be a really fun one because at the end of the day, the idea of retiring at 60 years old or later, it's antiquated, right? We want to retire as early as possible. And so hopefully these 3 strategies allow you to achieve that. So let's go ahead and dive in. So the first strategy that we're talking about is the 72T election. Okay. This is a tax election that you can make with a retirement account that would allow you to tap your retirement account early without incurring that 10% penalty, right? You can, in theory, be 30 years old and make this election and not have to pay that 10% penalty. Really cool stuff, right? So how does it work? So first and foremost, if you're going to make a 72T election, you have to make what are called substantially equal periodic payments from your retirement accounts. And if you're wondering what the heck is that, well, the IRS gives you 3 primary ways to calculate it. There's the RMD method of calculating it. There's the fixed amortization way of calculating it. And then there's the fixed annuity method of calculating it. Which method you choose is really based off how much income you want to derive. So generally speaking, the RMD method is going to give you the smallest amount of income. So for example, a 50-year-old wanting to make a 72T election with a $500,000 IRA balance, and they made the RMD method, that amount that they would have to take out, their substantially equal periodic payment, they would have to take out $15,000. Now that $15,000, while they'll still have to pay ordinary income tax on it, they won't have to pay that 10% early withdrawal penalty, which is huge. So again, that's why it's so attractive, is that you can tap those retirement accounts. It's another stream of income and you don't have to worry about that early withdrawal penalty. Okay, so number 1, substantially equal periodic payments, right? Bottom line is you can't just say, oh, I want to take out $50,000 out of my account. I'm just going to say it's a 72T election, right? Doesn't work that way. You have to adhere to one of those approved calculated methods that the IRS provides. Number 2, you have to adhere to either the 5-year rule or take distributions out until you are 59 and a half, whichever comes later. Okay. So for example, if you're 57 and you decide to make a 72T election, you would have to go ahead and make those substantially equal periodic payments until you are 62, since that comes later. If you're 30 years old and you made this election, you would have to make those substantially equal periodic payments all the way until 59 and a half, right? So you got a long runway to take these distributions out. Once you start the substantially equal periodic payments, they can't be undone, right? If you undo it, you might be subject to tons of penalties and taxes, right? So you want to do a lot of careful planning with this, and you want to make sure that you've calculated the amount that you need to take out correctly. In addition to that, typically, if you are going to deploy this strategy, typically you don't do it with your entire portfolio, right? So real life application of this when I've done it with clients. So I've had, clients want to retire maybe late 40s, early 50s, and, them and their spouse have, well over $1 million plus in retirement accounts. Well, maybe what we'll go ahead and do is we'll go ahead and carve out, right? Maybe a sleeve of those retirement accounts, call it $500,000, since that's the number that we've been utilizing. And with that $500,000 sleeve, that's where we'll go ahead and make the 72T election and take distributions out of there. It's almost like you've made your own annuity yourself, right? It's kind of a way that you can think about it. And so you go ahead and pay yourself from there, and hopefully that supplements your income, right? Again, when I've done this with clients, oftentimes they're kind of transitioning from full-time work into part-time work, right? So maybe that part-time work is something really fun they enjoy doing, and that little bit of 72T income coming in from the retirement account helps bridge the gap to full retirement down the road. So really, really cool strategy. When done right, can really complement cash flow planning, especially later on as you start to transition to maybe part-time retirement or full-time retirement. Can get really complicated. That's why perhaps you don't see a lot of people talk about it a whole lot, or people talk about it, but they don't really execute on it. But when properly planned around, can work pretty nicely. So tax savvy strategy number 2. This is the rule of 55, right? This is a really underrated method of taking money out of a retirement account that not a lot of people talk about. And quite frankly, a lot of financial planners neglect, right? And you're going to see why in a second. So first and foremost, in order to take advantage of the rule of 55, you need to have a 401k or 403b, right? It needs to be some sort of employer-sponsored retirement plan. And what this rule allows you to do is once you turn 55, you can begin to take distributions from that employer-sponsored retirement plan without that 10% penalty. Really, really cool stuff. Now, the reason why I say a lot of financial planners neglect this is that, if you've ever worked with some sort of financial advisor before, a lot of them are pretty excited to do a 401k rollover, right? And I get that, right? Rollovers give you more accessibility to investment options and all that good stuff. But when you're in this age range, right? Or if you're trying to do early retirement planning, right? You want to retire in your 50s potentially. This is all part of the game plan, right? This could potentially bridge the gap quite nicely to when Social Security comes down the road. Because if you were to have a 401k that is eligible for this particular method of distribution, the rule of 55, and you move that into an IRA, you would lose the ability to do it, right? So really, really important to keep that in the back of your mind if you are going to take advantage of the rule of 55. Also keep in mind that not all plans offer it, right? It's cool. A lot of plans offer it. you are going to have to contact your plan administrator to see if they offer it. And by plan administrator, I mean the actual folks running your employer-sponsored retirement plan, right? So if your 401k is at Fidelity, Fidelity might know your employer plan rules, but it isn't necessarily them that has made that distinction if you're eligible for Rule 55 or not. So just as a little side note, because I've had people say, well, Fidelity or Vanguard or whoever, completely screwed me over because my plan is not eligible for Rule 55. I need to take my money out of there. They don't make that decision. Ultimately, your employer does. So if you have issues with Rule 55 not being eligible for part of your plan, you got to take that up with your employer. So in practice, where I've seen this work really, really well is, again, folks that are looking to retire prior to their 60s, right? Want to retire sometime in their 50s. And so Rule of 55 allows you to start taking that money out of the, call it 401k, right at 55. Sometimes we'll go ahead and bridge the money from other sources. And before you know it, we've retired maybe in our late 40s, early 50s, and we've had pretty smooth income come along the way. And this works pretty nicely. So tax savvy strategy number 3. All right, so we've talked about Rule 55, right? Not everyone's going to be eligible for that. We've talked about the 72T election, but the reality is that with 72T, perhaps the income that you are taking, so maybe taking $15,000, $20,000 from the IRA in the forms of substantially equal periodic payments is just not enough to supplement your income. Well, this is where strategy 3 comes along. And this is more long-term planning, right? So if you are in your mid 30s, early 40s, and you got some time to work with, consider this approach. And it's the bucket strategy. Okay. Now, maybe you've heard about the bucket strategy, but I'm going to explain the way that I view it. And I think if you view it the way that I view it, maybe it'll make a little bit more sense. You can understand how this plays into traditional retirement planning. So there's really 2 primary bucket approaches that I want you to think of, okay? So bucket approach number 1, okay? I want you to visualize all your accounts, right? Maybe your retirement accounts, you have some brokerage accounts, you have some savings accounts, maybe you have some Roths, right? You got all these accounts scattered all over the place, okay? What I want you to do is categorize them in tax buckets, okay? So you got your tax-free bucket, you got your tax-deferred bucket, right? So that's just traditional retirement accounts, money that you got a tax deduction putting into it, but later on you're going to have to pay taxable income on, and later on you're going to have to report as ordinary income. And then you have your taxable bucket, okay? So you have these 3 distinct tax buckets. Now, from there, with those 3 distinct tax buckets, I want you to allocate how you invest that money in terms of when you are going to actually tap those buckets, okay? So maybe your Roth bucket, right? Maybe that Roth bucket, because it's so powerful, because the more years of tax-free compound interest that you can get on that Roth, the bigger it's going to be, and ultimately the more tax-free income that you can tap later on in retirement. Maybe it makes sense to actually grow that account as much as possible and leave it alone as long as humanly possible. Then your IRAs and retirement accounts, right? Maybe we're dialing down risk a little bit there because maybe we're going to retire early. Maybe we're going to utilize the 72T election and we're going to need to tap that account a little bit earlier. So maybe we dial down risk just a smidge there. Okay. And then your taxable brokerage account, right? Non-retirement accounts. This where maybe you're going to tap that money in the next 5 years or 10 years, maybe. Maybe we've dialed down risk substantially more there. And the reason why we're doing that is because maybe you're going to have to access that pre-tax tax deferred account and that non-retirement, non-tax deferred account when you quote retire, right? And that's maybe 50 years old. Okay. So having this bucket mentality, the reason why I'm bringing this up as a strategy is that it can help you with cash flow planning with early retirement. And again, I know this is kind of complicated, especially maybe listening to it without visualizing it. But the reason why I really want to harp on this is that so many folks really load up only on the pre-tax retirement account. Okay. They have no other financial resources, right? They have like maybe a little bit in their checking and savings account, and then all their money's in their 401k. Okay. They're sitting on a massive tax bomb. Okay. And then they want to retire at 45 or 50, right? And then they're like, well, I got all this money in my 401k, and if I touch it, I'm going to have to pay a bunch of taxes on it. And sure, rule of 55 exists and 72T elections exist, but man, that's still a lot in taxes. How do I manage that? Well, if you fundamentally understood what buckets you had available to you, if you fundamentally understood when you would need to tap those buckets would be ready for you when you retired at, let's say, 50, right? So if this is you, right? If you're listening to this and you feel as if, hey, I'm going to retire in the next 10 years and all my money is tied up in a 401k, I don't have much money anywhere else. Well, I would start thinking about, well, maybe it makes sense to start allocating a little bit to a brokerage account, right? Imagine if you had some money in a non-retirement account to help supplement your income at 50 years old, right? Imagine that. So bottom line, that is a really important consideration, is to understand where your money is allocated, what type of accounts the money is in, and how easily you can access that money prior to 59 and a half. And when you combine that approach, right? When you combine that approach with 72T, with the rule of 55, right? When you combine all these approaches together as one, that's really, really powerful, right? In my experience, when I've done this type of income and early retirement planning for clients, sometimes this is exactly what we do. We'll have like a sleeve carved out of an IRA doing a 72T election, right? Maybe that account itself provides $20,000, $25,000 worth of income. All right. Boom. That helps bridge the gap. Maybe they're in part-time work because they just like working part-time. Maybe that's another $40,000, $50,000. Cool. Add that to the income bucket. And then they have a brokerage account, right? That's spitting off some, dividends and interest, right? In a very tax efficient way. That's also supplementing the income. And before you know it, they almost have 6 figures in income that's supplementing their income, and they've already gone into part-time retirement. So can you use just one to achieve early retirement? Yeah, absolutely. But in practice, right, combining all of this can work really, really effectively. So hopefully you learned a thing or two. If you enjoyed today's episode, be sure to like and subscribe to us. We'll see you next time.